Today I'm going to share with you how major institutions actually buy and sell in the market, not with indicators, not with news, but by controlling order flow at specific price zones. Specifically, I'm going to break down the 4 supply and demand patterns through the lens of institutional order flow. Why does each pattern work? What's the iceberg order mechanism inside the base? How to draw zones precisely for each pattern type? And most importantly, how to tell a real zone from a trap. If you want to understand why price truly moves, this video is for you. And at the end of this video, I'll give you the 3-tier framework that institutional traders use, where multi-timeframe discipline allows you to place extremely tight stop losses and push risk-reward to 1 to 5 or higher when all 3 tiers align. But first, you need to understand why price truly moves. Most traders look at a chart and think, price moves because of candlestick patterns. That's not actually the case. Price moves because of one thing only: absolute imbalance between 2 types of orders. The first type, market orders. These are aggressive orders. The person placing one is saying, I want to buy or sell right now at whatever price is available. Market orders are the force that drives price, and they represent urgency, FOMO, panic, or triggered stop losses. The second type, limit orders. These are passive orders. The person placing one is saying, I will only buy at this price, no higher. Limit orders are the wall that blocks price. They represent patience and planning. And here's what matters. Inside the base, institutions primarily use limit orders to absorb, while retail, mainly through triggered stop losses, supplies the market orders that fuel the process. A note: when I say institutions, I don't mean a single entity acting in coordination. What I mean is the aggregate behavior of multiple large funds and algorithms that creates a common footprint readable on the chart. Like a river's current, no one commands each drop of water, but the flow still has a clear direction. When market slams into limit, if limit is large enough, price can't continue. That is the true nature of the base. Note, institutions also do use market orders, especially during the breakout phase when they deploy aggressive force to break structure. It's not always absolute, but knowing market and limit isn't enough. Because there's a type of order you cannot see on the chart, and that order type is the real key to understanding the base. That order type is called iceberg orders. When a hedge fund wants to accumulate hundreds of thousands of contracts, they absolutely cannot dump them all at once. If they did, price would slip out of control. Instead, they hide their orders, and the process unfolds in 3 steps. Step 1, passive absorption. Institutions place massive buy limits at a specific price zone. They leverage the market's natural selling momentum. Bad news, momentum selling. And in some cases, use algorithms to accelerate the process in order to trigger retail stop losses. And the nature of a long position stop loss is a market sell. That cascade of market sells slams straight into the institution's buy limit wall. Step 2, risk transfer. On the chart, what do you see? Price oscillating in an extremely tight range, small body candles, looks indecisive. But in reality, this is a stealth war. Every time the order wall is eroded, the iceberg algorithm automatically reloads. Institutions are quietly transferring risk from retail into their own inventory. Step 3, breakout. When they've accumulated enough and selling pressure is exhausted, institutions pull liquidity above, meaning they cancel the sell limit orders they themselves had placed to control price. When they no longer need to suppress it, they remove the wall, leaving the upside wide open. Then they fire aggressive market buys. The result, even a small buy force, is enough to launch price skyward, creating a massive ERC, extended range candle, and behind it, a price gap, fair value gap, or FVG, where price jumped so fast that the next candle doesn't overlap the previous one, leaving a zone with no transactions. FVG is crucial because institutions often pull price back to fill this gap, turning it into a potential entry zone. You can't see iceberg orders directly on the chart, but you can see their footprint, a tight, compressed consolidation zone. That's the absorption footprint. A massive ERC breaking structure. That's the breakout footprint. Read the footprints correctly, and you know who's in the room. And from here, you have 2 measurement standards. A proper base is a tight consolidation zone. The candles inside are small relative to the surrounding moves, narrow range, overlapping bodies. The key is contrast. The base must look calm and compressed compared to the explosive ERC that departs from it. If the candles inside are large and impulsive, that's not a base, that's continuation momentum. A proper ERC candle, body fills at least 80%, size at 1.5 to 2 times ATR. ATR is average true range, the market's average range of movement. In other words, the ERC must be significantly larger than normal, and it must break structure, meaning it closes beyond the nearest significant high or low, confirming that control has changed hands, or leave behind an FVG. Now you understand how a base forms. But there are 4 different ways a base appears on the chart, and each one carries a completely different meaning. The first pattern, and the strongest, DBR, drop, base, rally. In other words, the leg in, the price move into the base. Here, it's a strong drop. Then the base, the consolidation zone, and finally the leg out, the price move away from the base, which is the ERC candle departing. This is a bottom reversal pattern. It creates a demand zone. From the order book perspective, what is this? Maximum absorption. Rock-solid limit buys, cutting off the entire panic selling momentum of the market, draining all available selling liquidity, then blowing price away. This is a structural change in intent. Institutions have decided, we will reverse the trend right here, and the capital commitment is extremely high. How to draw the zone using 2 lines. The proximal line, meaning the near line, where price touches first on the return. This is the entry trigger, drawn at the highest wick of the base cluster, and the distal line, meaning the far line, the final boundary, beyond which the zone is invalidated. This is where your stop loss goes, drawn at the lowest wick of the entire formation, including the leg-in candle, protecting your position below the extreme liquidity tail. And here's how to trade it. After the ERC departs, price may return to touch the proximal line. Not every zone gets retested. Some zones see price leave and never come back. But if it does return, this is your entry point. Place a buy limit at proximal, stop loss below distal. Because capital commitment is extremely high, DBR zones are typically defended aggressively on retest. Probability of a bounce is high. But remember, if price closes through the distal line, the zone is completely invalidated. No extensions, no hoping. Cut the loss. DBR is a fortress. The first touch, first test, offers superior probability, especially when the 3 scoring criteria are met and the higher time frame bias is aligned. Bias, directional lean, is the direction that large money is pushing price on the macro time frame. If the D1 bias is bullish, only look for demand zones to buy. Never trade against the bias. DBR is the king of supply and demand, but its twin sibling, RBR, is a double-edged sword. I'll explain why, after you understand RBD. The second pattern, RBD, rally, base, drop, the mirror image of DBR. This is a top reversal pattern, creating a supply zone. At its core, distribution capping the top. Massive limit sells, devouring the crowd's euphoric top chasing. Institutions are handing off risk from themselves to retail. Institutions sell, retail buys. This is also a change in intent, extremely high capital commitment. This is where CHOCH, change of character, forms. That means price for the first time fails to continue the old trend, creating a lower high in an uptrend or a higher low in a downtrend. This is the earliest signal that the trend is about to reverse, and RBD is where CHOCH appears most powerfully and violently. Zone drawing mirrors DBR. Proximal line, the lowest wick of the base cluster. Distal line, the highest wick of the entire formation, including the leg-in. Same trading approach. Price leaves the base, then retraces up to proximal. That's your entry. Place a sell limit at proximal. Stop loss above distal. Extremely high capital commitment. Zone holds strong on retest. And just like DBR, if price closes through the distal line, the zone is completely invalidated. Cut the loss. No exceptions. DBR and RBD, the reversal pair. 2 fortresses, highest capital commitment, strongest probability, and the first touch, first test, remains the best opportunity. Those are the 2 fortresses. Now, on to the 2 tenths. And this is where most traders make fatal mistakes. RBR, rally, base, rally. A bullish continuation pattern also creates a demand zone, just like DBR. But the liquidity mechanics are completely different. Remember, DBR must fight against the entire downward momentum, break the full force of selling pressure, requiring massive capital. That's a change in intent. RBR does not. Price is already rising. Institutions are moving with the trend. The opposing force is just retail taking profits early, and a few counter-trend traders jumping in to sell, far smaller than the full bearish momentum that DBR must overcome. Institutions pause their push, absorb liquidity from this small opposing source, then continue pushing. No change in intent, no need to break opposing force, so capital commitment is much lower. And when price returns, the RBR zone is not defended as aggressively as DBR. If DBR is a fortress, then RBR is a tent. And zone drawing is different too. Proximal line, same as DBR, highest wick of the base cluster. But distal line, skip the leg in entirely. Only take the lowest point of the base cluster or the leg-out candle. Why? Because if price breaks below the base floor in a bullish continuation, it means the buying reinforcement has failed. The continuation thesis is broken. Extending your stop loss down to the leg-in is pointless. How to trade? You still place a buy limit at proximal, stop loss below distal. But, because commitment is low, the zone may get penetrated on retest. So with RBR, you need volume confirmation before trusting it. Specifically, the no supply signal. I'll cover this later. And here's the warning. RBR has a very high probability of failure if it appears in a late-stage trend, or if it runs straight into a reversal zone from a higher time frame. And institutions frequently use RBR as bait. I'll show you the exact mechanism of this trap in the inducement section. But first, let's look at the mirror copy. Because if RBR is already dangerous, then DBD is equally dangerous. DBD, drop, base, drop. A bearish continuation pattern creates a supply zone, the mirror image of RBR. At its core, redistribution. Smart money pauses the decline, creating the illusion that the bottom is in, luring bottom fishers to jump in, accumulating more sell orders, then smashing support below. Compared to RBD, DBD is just a pause, not a trend break. Lower commitment. Zone breaks more easily. Zone drawing. Same logic as RBR but mirrored. Distal line. Skip the leg in. How to trade. Sell limit at proximal, stop loss above distal. But like RBR, low commitment. Zone may break on retest. You need volume confirmation, a no demand signal before entering. No blind limit orders. Same warning. DBD is often a liquidity sweep trap, luring late short sellers, then ripping back up to stop them out. So remember this. Reversal, fortress, high commitment. Distal includes leg in, strong retest, can place limit directly. Continuation, tent, low commitment. Distal excludes, leg in, retest needs. Volume confirmation, no blind limit. 4 patterns, 4 mechanisms, 4 retest behaviors. But the question now is, out of the hundreds of zones that appear every day, which zone is worth trading? The market creates hundreds of base zones every day, but an institutional trader only picks A+ zones. And here's how they filter. Criterion 1, time at base. How long the base has been forming. In supply and demand, speed is strength. Ideal, 1 to 6 candles. Why? With strong reversal zones, bearish momentum crashes down quickly, creating abundant liquidity in a short time, so institutions can accumulate enough in just a few candles. Fill up, push price immediately. Don't let anyone else board the train. But if the base drags on, 15 candles, 20 candles, retail pending orders pile up densely on both edges. That zone becomes a liquidity pool, bait for stop hunts, instead of a barrier. Criterion 2, strength of departure, the departing force. The ERC must create shock and awe. Strong ERC, large FVG, valuable zone. If price leaves the base sluggishly, small candles stacking up, no institution participated there. And the profit margin rule, the price distance from proximal to the furthest point after departure, must be at least 3 times the zone width, meaning the distance from proximal to distal. Purpose, ensure there's enough room for risk-reward when price returns to test. If the zone is right next to the next resistance, R to R isn't worth it. Criterion 3, freshness, limit orders, are finite. Every time price touches the zone, some orders get filled, the wall thins. Touched once, solid. Touched twice, thin. Touched 3 or more, nearly depleted. Zone ready to collapse at any moment. Only trade the first touch. Fresh zone. Completely eliminate zones that have been hammered. Now, put yourself in the position of a risk manager. On the left, an RBR, 15 base candles struggling back and forth. The departure ERC is weak. A retail trader draws a box around those 15 candles and cheerfully places a buy limit. But the order book perspective tells you something different. 15 candles prove two sides fought to a standstill and nobody won. Weak ERC equals no big player. This zone is extremely fragile. On the right, a DBR, 2 base candles, massive full-body ERC, large FVG behind it. That's the unmistakable footprint of institutional money. How long does it take you to tell them apart? 10 seconds. No indicators, no emotions. 3 criteria, evaluating shape. But there's one more layer, volume, the most tamper-resistant evidence available. Analyzing price action without volume is like a doctor reading a file with the heartbeat covered. Volume is one of the hardest pieces of evidence to fake on the chart, especially on exchanges with real liquidity like futures or equities. Note, on Forex, we use tick volume as a proxy, and on crypto, you need to choose reputable exchanges to avoid data distorted by wash trading. Volume needs to be read at exactly 3 beats. Beat 1, leg in. Volume explodes. This is the climax. Retail is panic selling, or FOMO chasing tops. Rich liquidity, served up for institutions. Beat 2, base. This is the focal point. 2 scenarios. 1, absorption. Extremely narrow candle range, but volume spikes dramatically. This is an anomaly under Wyckoff's law of effort versus result. The effort being poured into selling is massive, shown by high volume. But the result of pushing price down is 0, shown by the narrow candle body. When effort is high but result is 0, it means an opposing force is absorbing everything. That is institutional money. 2, exhaustion. Narrow candle range, and volume also drops off dramatically. Selling pressure has completely dried up. Nobody wants to sell anymore. Beat 3, leg out. The ERC must come with exploding volume, confirming commitment. But what if the ERC is very long yet volume is low? That's a breakout through thin liquidity. A thin liquidity breakout. Price will soon come back. Don't chase. And when price returns to test the zone, reading volume is critical. Testing a demand zone, price drops back with shrinking candles, volume declining, noticeably lower than the most recent candles. That's no supply. The sellers are spent. Safe to buy. Testing a supply zone, price retraces up with small candles, upper wicks, volume declining. That's no demand. Buyers are exhausted. Safe to sell. But if price slams into a demand zone with large red candles, volume surging, don't catch the knife. Selling pressure hasn't washed out. Zone is about to break. But even when you have the 3 criteria and volume, there's still one type of trap that institutions engineer specifically for smart traders. In the smart money framework, there is one supreme principle. Institutional profit is built from the stop losses of the crowd, and institutions don't passively search for liquidity, they create it. Here's the mechanism. After a strong break of structure, price pulls back, forming an RBR zone that looks absolutely textbook, exactly what the manuals show. The crowd gets excited, draws the zone, places buy limits, and places stop losses right below the base. But this RBR is not where institutions intend to buy. It serves as inducement, bait, whether intentional or incidental. It doesn't matter whether institutions deliberately created it or not. What matters is the outcome on the chart is the same. Retail places. Stop losses exactly where liquidity will get swept. Then, price slices through the RBR. A chain of sell stops triggers. Domino effect. Liquidity sweep. All the liquidity from the crowd's stop losses funnels straight into the institution's real buy limits, at the original DBR zone sitting deep below. The crowd gets crushed at the RBR, and that is the fuel for the DBR to launch. Now you understand why RBR is a double-edged sword. 3 fatal mistakes to avoid. 1. Treating zones as permanent. 2. Chasing thin liquidity breakouts with FOMO. 3. Trading RBR or DBD against the higher time frame trend. So, how do you avoid this trap? The answer lies in the 3-tier framework. This is the framework I promised at the beginning. The 3-tier model. How institutional traders nest multi-timeframe analysis to avoid traps and enter with extremely tight stop losses. Tier 1, macro, D1 or H4. You don't trade here, you only establish the compass. Mark the major DBR and RBD zones, untapped liquidity zones. Determine which direction price is being drawn toward. And absolutely, never open a position when price is floating in the middle, no man's land. That means price is sitting between two major S and D zones, not near any zone at all, with no barrier to protect you. Placing a trade here is gambling. Tier 2, intent, H1 or M15. When price touches the H4 DBR zone, you zoom in here and look for what? Signs of manipulation. Price pierces a local low, creating fear, but immediately snaps back aggressively with a change of structure. CHOCH. The trap has sprung. The crowd is locked in. Smart money has taken over. And the touch that creates this CHOCH is the first test of the D1 zone. You're entering on the same touch, just at a smaller time frame. The zone is still fresh. Tier 3, entry, M5 or M1. Only when, and only when, Tier 1 and Tier 2 are fully satisfied. You find an FVG or a micro DBR right at M1. Place the order. Extremely tight stop loss. And risk-reward can reach 1 to 5 or higher in ideal scenarios. But remember, superior R to R is only achievable when all three tiers align and you trade major pairs with low spreads. Missing one tier, no trade. This is discipline, not a magic formula. D1 for the compass, M15 for confirmation, M1 for entry. 3 tiers, 1 decision. 4 patterns, 2 fortresses, 2 tents. 4 different liquidity mechanisms, from drawing zones specifically for each pattern, to the 3 scoring criteria, to volume confirmation, to identifying inducement traps, and finally, the 3-tier framework to enter on the same side as institutions. That is the entire system. Imagine the next time you open a chart. You see a base zone. You instantly know, is it reversal or continuation? You draw the zone for the correct pattern type. Score it in 10 seconds. Check volume. Scan for inducement. Zoom the 3 tiers. And enter, with an extremely tight stop loss, on the same side as institutions. No more guessing. No more being fuel. Drop a comment below and let me know, out of the 4 patterns, which one do you trade the most? DBR, RBD, RBR, or DBD? Thanks for watching. See you next time.